it's a bull market. There's no denying it. We've been saying it. You look at the earnings, you look at the guidance, you look at the surprise on earnings. Everything is pointing upwards, and we always say don't fight the bull, right? So the three things that I look at, valuation, are a little bit tense right now, so not exactly competitive in the United States, but otherwise sentiment and earnings are phenomenally, are doing really, really well. So, and even you mentioned JB Diamond, his guidance has been upgraded, even though he's cautiously pessimistic going forward. So where do we go from here? Don't fight the bull, keep riding that trend, but be cautiously optimistic. What we said in December remains: 40 equity, 40 bonds, 20% cash. That's how we say it. We say it by allocation. So yes, it's good. We don't know how long it will last.
Okay, so talk to me about why we've seen GCC equity markets underperforming the US and even some emerging markets as well. What's holding markets in our region back when we see so much optimism on Wall Street?
Yeah, that's a great question. We're diverging from the rest of the world, excuse me, to some extent, and this has been the case for some time. First we had Russia and Ukraine, then we had China with economic uncertainties, and we in the GCC are a tail market in the emerging markets, so we're suffering doubly, if I may say. Now, the funny, or not very funny, but compelling argument is that China has been rebounding since February, and we said at some point in March that this rebound was overdue, was trading at single-digit PEs. And even though China is rebounding, we are still doing nothing. So it seems that since 2022, our markets have been, not as strong as we would expect. Yet, you look at the fundamentals, they're absolutely phenomenal. GDP growth is here. Earnings are growing. Margins are solid. Visibility is second to none. And valuations are very compelling. In my view, it's a matter of time before we catch up with the rest of the world.